We have a group here in our conference room, and then we've got folks who are on a webinar that will be doing this remotely. Just a couple housekeeping things. We're, phones on mute. We're going to be taking questions at the end of the seminar, and so we'll allow some time for that, and we'll be here afterwards if people just want to come up independently as well. People doing the webinar can type in their questions, and we'll have a record of those and try to answer those as well should they come in. So with that, we'd like to get started. My name is Sheryl Morrison, and I work in the Trust and Estates and Charitable Gift Planning groups here at Gray Plant Mooty. Have been practicing for, I just went to my 30-year law school reunion, so that math is easy. And I don't know if you want to introduce yourself, Greg, and then Wade, and we'll do that first.
Sure, and I'm Greg Larson. I work with Sheryl frequently. I'm on the nonprofit organizations team, so work every day with organizations like yours.
Great. And I'm Wade Hauser. I'm also in our nonprofit group. I work with both Greg and Sheryl and kind of try to support both of them in the projects that they take on.
Great, thanks. Well, let's get started. We've titled our topic, Navigating the New Tax Law Changes in the Nonprofit World. And I first want to just take a moment of silence, if we can. We all know that this, the anniversary of Prince's death just passed. It's only interesting in this context because we're not exactly sure what to call him. And the same is true of the new Tax Act. So I was trying to think of what sort of glyph could we devise for the new Tax Act. The technical name is an act to provide for the reconciliation pursuant to Titles 2 and 5 of the concurrent resolution on the budget for fiscal year 2018, okay? Formerly known as the Tax Cuts and Jobs Act. I personally kind of like the paint splatter as an option for a glyph, because to me it says either we're sort of in the sights of the paintball gun, or somebody threw everything against the wall and saw what stuck. So we're going to talk a little bit today about the charitable giving changes that happened in the Act. Greg will pick it up from there and talk about the specific laws that affect nonprofits and governance and tax rules there. And then Wade will talk about everything else. So the Tax Act, and that's what I'm just going to call it because I don't know what else to call it. The Tax Act was really not great for nonprofits. It wasn't as bad as it could have been. And in some ways, things didn't change, but there's been sort of, gloom and doom spoken about with respect to the Tax Act. I'll call your attention back to 1986 when there was a tax reform bill, and there was also gloom and doom, but the charitable giving that people were concerned about back then really was not severely impacted. Whether the new tax law will have severe impacts or impacts on charitable giving, and what those will be and the extent of them has yet to be seen, of course. The Act was in large part effective January 1 of this year for the charitable giving and estate and gift tax provisions, which is what I'll talk about. And so we're just kind of hoping, I think, to arm you with some thoughts and ideas as well as knowledge about how to react to the Tax Act. And, some things you can think about. As I say, we'll answer questions at the end because I think there may be a lot of them. So let's start with some of the charitable giving changes that occurred in the Tax Act. And now it's been around for a number of months. People are probably familiar with some of these things. So I don't want to spend a lot of time on the technical things, but spend maybe a little more time on some of the, what you can do, or what are some of the strategies that you can still talk with donors about in your work. that may still be successful. So that's kind of what I want to focus on. But let's talk about some of the underpinnings so we all have a common layer of knowledge to speak from. First of all, the standard deduction is higher for individuals for income tax purposes, up to $12,000 for a single person, $24,000 for a married person. Used to be $6,300 for an individual and $12,600 for a married person. What this probably means to donors are that certainly those donors who make smaller charitable gifts and whose other deductions may not exceed that standard deduction, they may, not want to make charitable gifts if they can't deduct them. That's one possibility. Donors who make larger charitable gifts, such that it would exceed their standard deduction, those folks may well continue making those gifts. On the other hand, some donors just may make gifts no matter what, right? They're not concerned so much about the deduction. And those donors aren't going to care about these rules to a great degree. They're going to contribute to the causes that they always have contributed to and want to continue contributing to because they believe in those causes. There are some statistics, or at least these are projections, if you will, about how this standard deduction may affect people who itemize, and therefore possibly people who might affect their charitable giving differently now. From the Tax Policy Center, 11%, or it's projected that 11% of households will now itemize. That's down from 26% under the old law. In Minnesota, the Department of Revenue projects that 13% of Minnesotans will itemize. That's down from 36%. So things to think about there. There's also lower rates this year. Not much lower, but a little lower, particularly at the top end. Some people's view of that in charitable giving is that charitable deductions don't count as much. They don't save as much tax. Again, for those donors who aren't as focused on tax, that rough odd 2% difference is not going to make a significant difference to them. One good thing is that the top deductibility limit for cash gifts has been raised to 60% from 50% before. This is for gifts to public charities. So that's a nice change to see. But other than that, the limitations, the percentage limitations on the percentage of AGI that can be deducted by a donor remain the same. There's still a 5-year carry forward. And so those changes are important to keep in mind. There's also a change that might affect some of you in the room, some donors as well. It used to be that donors who made a deduction and in sort of exchange for that deduction, they received a right to purchase athletic tickets. That deduction is gone for those kinds of donations. You can still get a deduction for making a gift to an athletic department or to a university. It just can't be tied to that purchase of athletic tickets. So that may affect some people, and higher ed institutions are thinking about ways to deal with that, keeping those donors, are they still going to get those more significant deductions if they're not offering that benefit, or focusing on the fact that, are you really doing it for the deduction, right? Because if you're getting that benefit to be able to purchase the tickets, it really is sort of a quid pro quo, and the reality is that has not been recognized in the past. So let's talk about some strategies that you can talk with donors about. And the first of these is just sort of bunching deductions so that in 1 year, if the donor can bunch all of the charitable deductions and other deductions in that year, then they can exceed the standard deduction that is now higher and therefore deduct what they intended to deduct, and then not make those charitable gifts or deductions in the off years. So that's a strategy that donors are going to start using. It's being discussed very commonly out there in the financial planning industry and wealth advisors, so that's something that you will see. It can create issues for your budgeting and, you know, sort of trying to figure out what the heck you're going to do, because there may be those, you know, off years that you would have liked to see the donors giving every year, and that may well not be what is going to be the case going forward. In that context, particularly community foundations will probably see greater contributions to them. And the reason for that is that where they house donor-advised funds, they can be talking to donors about bunching their gifts into donor-advised funds, and thereby taking the deduction this year for that larger gift, that bunched gift, but parsing out the funds in the off years later. What that means is that you need to be really in touch with your donors about what they're doing in this context. If they're making the contributions to donor-advised funds, you want to be on their list of institutions that are going to get the distributions from the donor-advised funds when they come. The other strategies is that if you have donors who have pledges out there, if they're talking about this idea of bunching or making contributions kind of all in one year, more so than they otherwise would, they can pay off their pledges early. That might be something for them to consider. It may be something that they, you know, now that there's more of a tax benefit, and perhaps the only tax benefit, to do it all at once, that might be something they would consider doing. They can also sort of prepay gifts to you for future years. It's like the donor-advised fund alternative, but giving to your institution. If they otherwise would have given you $10,000 a year, talk to them about giving you more this year, kind of prepaying the next 3 years or however they're structuring their giving, given that standard deduction issue. Minnesota still has a law out there for non-itemizers that they can subtract 50% of charitable contributions over $500 from their computation of taxable income for Minnesota. So yay, Minnesota, we're ahead of some states with respect to this issue and this problem, because we've had that law on the books for a while. Let's talk a little bit about estate and gift tax changes, because the way that this may affect you and your organization is that for tax-motivated donors, their exemptions from the federal estate tax have gone up. Their exemptions from the Minnesota estate tax have gone up for your Minnesota donors. And for somebody who is tax-motivated, those changes might lead that person to conclude that they should make fewer charitable contributions because they won't be saving the tax. The exemption will save them the tax, not the charitable deduction. So for those donors who are solely tax motivated, this may be something that will affect their giving. Each donor, each taxpayer, now has an $11,180,000 exemption from federal estate tax. The rate for federal estate tax is still 40%, but the exemption is $11,180. If you're talking about a married couple, that's $22,360. So it's a significant jump from what it used to be, which was $5.5 million. So that change could be significant for donors who are primarily motivated by those sorts of ideas. Minnesota's exemption has gone, or will go up to $3 million. This year it's $2.4 million. It goes up by $300,000 in each of these years. Recall that Minnesota has an estate tax, one of the relatively few states that do. So for your Minnesota donors, their exemption in Minnesota is significantly less than their federal exemption. Now, the Minnesota rate is also significantly less. It's 12 to 16%. So they're not saving as much taxes by making a charitable deduction donation to you at death as they would be at the federal level. Nonetheless, they are saving taxes. On the other hand, you may have donors who just don't care about the tax benefit or the tax detriment. They're going to be focused, again, on what is it that you're doing, what is your mission, and how can they help. And for those donors, this information may be helpful. It may help them structure some things differently. They all should be reviewing their estate plans in light of this change. But for donors who are not primarily tax motivated, this may or may not be a consideration for them in their estate planning. So again, focusing on that, less so focusing on the tax issues for donors for whom this would exempt them from tax. And your message should focus more on how can you help us and how can we help you create your legacy with us. So those are some ideas about the tax law changes in this context, income tax and gift and estate tax. Let's talk a little bit about what still works and what kinds of things you can still be working with your donors to do that are still really great tax planning strategies to make charitable gifts. And the first is the IRA rollover. The IRA rollover has been around for a decade, and there's some requirements. The donor has to be 70 and a half, so they have to be sort of in pay status, if you will. They can gift only up to $100,000 per year per taxpayer. There's some requirements about who the recipient can be. It has to be a public charity. It cannot be a donor-advised fund. That's really important, and we see people running afoul of that. But the benefit from a tax perspective of this kind of gift, a direct rollover from the IRA to the charity, is that that income will not land on the donor's return. It will just completely skip by the donor's return. So the donor will not have to take that income in, report it, and then make a charitable contribution. And you might ask, well, what difference does it make? Isn't it a wash? It may not be a wash. There's all sorts of tax rules that kick in at thresholds that may, things like Social Security tax and other sorts of things that kick in once you reach certain income levels. And so to have the income not appear on the tax return means that those levels are not going to be reached for those tax, adverse consequences that might otherwise apply. So for a donor who is in a situation where they don't, maybe they already have met their percentage limitation for gifts for the year, but they want to make another gift. This would be a perfect way to do that because it doesn't land on their return at all. It's not subject to their percentage limitations. For people that don't itemize, who otherwise wouldn't get a benefit from a tax deduction, a charitable deduction, again, this is not a deduction, but it's an exclusion of income for that donor. So it still works for those kinds of folks. And in fact, for non-itemizers, this is probably the best gift they could make. So stressing this kind of gift is important, and there's lots and lots of IRA money out there that donors are not going to use. And so this kind of gift is important for you to focus on as well. This kind of gift can be used to pay off pledges, so that's something to note. There's requirements. If you're interested in those, we've got some collateral materials we could send you on that for what those requirements are. But this kind of gift is still really important to think about in this context, and is a better gift than it even used to be because of the tax law changes. Donating appreciated property. Yeah, Marie.
I just wanted to point out that when your donors are talking to their financial advisors don't use the term IRA charitable rollover. They use the term QCB or qualified charitable distribution. So you need to know both those terms when you're discussing that and asking your donors to talk to their advisors about it.
Good point. Yep. That's the technical term for it out of the tax code. Donating appreciated property. So when you think about somebody donating stock, if that person bought a share of stock for $100 and it's now worth $200, that has built-in capital gains of $100. If a donor donates that stock to charity, the donor gets a deduction for $200, the fair market value of the property, does not have to recognize that capital gain of $100 on his or her income tax return. And that is still a huge benefit in today's tax world. Again, there's that idea of not recognizing income on the tax return, which is a benefit for not having to bump up against some of those adverse tax consequences. And the donor still gets a deduction for the fair market value of the gift. So that sort of gift of appreciated property is still a good idea, and for folks who are itemizers, this kind of gift, again, is perhaps the best gift they could make. So it's important to know that when you're talking with your donors and to help them think about what kind of gifts they can still make and what are the benefits they can get in today's changed tax world. For business owners, they have stock in their business, and for many of those owners, they're trying to think of how to get the business onto their children, for example. And they're also philanthropic. They could make a gift of stock in their company to your organization. They can take a deduction for making that gift. They cannot recognize the capital gain inherent in that stock, which is perhaps the whole amount, because if it's a founder, they have almost no basis in that stock. Their children or the company can turn around and buy that stock from the charity. The charity ends up with cash. The children or the company end up with the stock. And the donor has shifted percentages of the company onto his kids without any gift tax consequence. If the donor had just given that stock to the kids, there would have been gift tax consequences to that gift. So this is a way, it's called a charitable bailout, this is a way that owners of companies can be philanthropic, shift value to their kids without adverse consequences, and also have an income tax deduction that they can take for that as well. The last thing I want to spend time on is charitable remainder trusts, and this is, again, a kind of option for somebody who's got appreciated property, wants to liquidate that property, but to do so in a tax-efficient way so that he or she can continue to take money or income from that property for the rest of his or her life. This trust is structured exactly that way. The donor makes a gift of property to the trust, can take a charitable deduction for doing that, and then the trust can sell the property and pay an income stream to the donor for the rest of the donor's life. The donor does not recognize capital gain all at once. The trust itself is tax exempt, and so the trust will not have capital gains on a sale of the stock. But as the trust passes out that income stream to the donor will start to recognize some of that income. This kind of strategy is a great strategy for a donor who's ready to diversify a concentrated portfolio, for example, and doesn't want to do that and recognize capital gain all at once. Using a charitable trust can facilitate that result and provide a lifetime stream of income to that donor. And he will also get a charitable deduction and really spread out that gain recognition over his or her lifetime. So that's an idea to think about with your donors. And so as I conclude, I just want to note, this is we're using glyphs again, by the way. The Tax Act with respect to gift and estate tax changes and the income tax changes that I was talking about sunsets December 31, 2005. So to quote Prince, we should be partying like it's December 31, 2025. It's possible the law will change before then. All it takes is a change in Congress and some motivated people to change it. So whether it lasts till 2025, we have no idea. There's already, you know, proposals afoot that would seek to change some of these things. But if nothing changes, we're stuck with that until December 31, 2025. And so with that, Greg, I'm going to turn it over.
Okay. Thanks, Sheryl. So my stuff that I'm going to talk about is not set to sunset, so there really would have to be a legislative change. As you in the tax-exempt sector know, tax-exempt doesn't mean tax-exempt for all purposes. You already pay a bunch of different taxes, and some of them are listed there. What happened mostly with respect to these taxes is that more of them were added. And I just want to run through a little bit about what changed to unrelated business income tax. And then there was a change to a new tax on fringe benefits, parking and transportation fringe benefits, and then a new excise tax on executive compensation that will be relevant to some of you, and least likely to be relevant, but still part of the act, was a new excise tax on large university endowments, and we'll just touch on that really briefly. So just so we're all on the same page, when I say unrelated business income tax, I'm talking about income from a business that's regularly carried on and that is not substantially related to your mission. So if you have that kind of income, you already are paying tax that we just shortened to UBIT. Of course, you only pay taxes on the net income. So there's an allowance for offsetting some of your income with allowable deductions, and then when you pay the tax, it's paid at the standard corporate rates. So there were two kind of streams of changes with respect to unrelated business income tax. One, the corporate rates changed, and two, the deductibility rules changed, and they both are potentially something that could affect your organization. So under the prior law, of course, you had the progressive corporate rates, and now we've moved, just as the rest of the corporate world has, to a flat rate of 21%. So this is either good news or bad news depending on how much unrelated business income you were reporting. So if you're someone who was reporting only a small amount of UBIT or a small amount of UBTI, you would have been formerly taxed at the 15% rate, and now you are going up to the 21% rate. For others who are reporting more, this represents an actual reduction in the tax. But there's part two to the analysis, which has to do with so-called UBIT siloing. So this is a change in what kinds of deductions you can take. It used to be that you would sort of put all of your unrelated business income and all of the associated deductions into one big bucket. So if it was from any kind of unrelated business income stream, it would be, you could sort of put loss leaders and and lines of business that made a lot of income and use the losses from the loss leaders to offset the ones that were making more money. You could also carry forward excess deductions as net operating losses for future years. That didn't go away, but we'll talk more about that in just one second. The big change is that now you have to analyze the losses per specific stream of income. And we're not quite sure what this means exactly. We'll talk about that in just one second. But if you have a line of business, you can only use the losses from that particular line of business to offset the income. And this change is something that the Joint Committee on Taxation is expecting will be a revenue increase for the government. So that means, you know, they expect this is going to affect you by raising your taxes. The estimate, I think, is $3.2 billion over 10 years is what they're projecting. So for most of you, this would be, you know, this is going to result in a tax increase if you are, if you're already reporting UBIT. The big question in this is, what do you mean line of business? So if you have a whole bunch of investment income from various partnerships, can you lump all those together? Or do you have to take each investment separately? If you have sort of like types of business lines, can you lump them together? Or do you have to sort of be super literal in the way that you are splitting them out? The good news is that Treasury is very aware that this needs attention. It's already generated a lot of questions, and Eleanor Ramsey in the tax policy department of Treasury has said that they need to issue regulations on this sooner than later. And then to paraphrase, she says, any ideas? So they're definitely going to be looking for comments. So you will have the opportunity to weigh in with public comments, I hope, in the near future. We haven't seen anything yet. The thing that concerns me a bit about this sort of move toward disaggregation is that it is likely to expose to easier scrutiny which lines of business are consistent losers. And to the extent that you have lines of business that have sustained losses, and by sustained losses I mean like 3 out of 5 years they're not making any money. For those types of lines of business, the IRS does not like to acknowledge that they're business. So remember, to be unrelated business income, it's got to be from a trade or business. And the IRS on audit will frequently take the position that this line of business has no profit motive. And you're just sort of maintaining it in order to use the losses from it. And so that it could definitely be something that will be disallowed as well. So the next change is this fringe benefits thing that I mentioned on qualified transportation benefits and qualified parking. This is actually, this benefit, or what most people think of as a benefit, has come under the UBIT rules. So you are actually going to be paying unrelated business income tax on your organization's expense of providing this benefit to your employees. This is already effective, so it's a little hard to sort of plan for retroactively, but what it means is that if you provide, if you pay for this for parking or transportation directly for your employees, or if you provide it as a pre-tax benefit, you will now have to pay a 21% tax on the value of that benefit. So the big issue here, I think, is less that tax, which you can kind of plan for. I think a lot of people are deciding that they would rather just gross up the compensation, the standard compensation for their employees to avoid this 21% tax. You're still going to then have to pay payroll taxes on the additional compensation, but you will probably come out ahead if you do that. In my mind, the bigger pain related to this particular change is that for organizations that don't have any other kind of unrelated business income, and so never before had to file a 990T, which is where you report that income and pay tax if any is due, are suddenly going to have to file a 990T. And that is something that, in my opinion anyway, the IRS exempt orgs division is ill-equipped these days to take on. So it's going to be a big administrative hassle for you and an even bigger one for the IRS, which has experienced just lots and lots of departures of experienced people in the exempt orgs division, and the IRS as a whole has seen its budget reduced recently as well. Okay, so the next thing of note is a new tax on executive compensation. And so the idea here is that for certain covered employees, if you pay compensation to them over $1 million, that amount is going to be subject to a 21% excise tax. And separately, for covered employees who are paid an excess parachute payment, and we'll talk about that in a second, the same 21% tax could apply. There's a couple things to say about this. One is that it appears to be an attempt at creating parity between your for-profit counterparts and nonprofit organizations, or at least the for-profit public companies who already can't take a deduction for the expense of paying their executive employees over $1 million. So there's an idea there that we're trying to put nonprofits on the same footing as for-profits. We don't have the benefit of having had sort of a policy discussion about why or why not that parity is a good idea. The other thing is that in the drafting of this law, it appears to exempt public institutions. So it would not apply, current state, to public universities. Now, if you look at the legislative record, it's absolutely clear that Congress intended to tax, public universities, maybe especially. So they were talking about highly paid athletic coaches and other, CEO, presidents of colleges and universities. And because of the way it was drafted, that actually does not come through. So there is this idea that it could be subject to technical correction. That also is problematic because, as Sheryl read to you, the long name of the act contains the word reconciliation, and that means that different legislative rules apply than if it were a new act, and it means that to make what would really be a substantive change, it may very well be that they need 60 votes, not the lower threshold of votes. So it'll be interesting. I've heard lots and lots of people say that it's going to be subject to technical correction and that will be coming soon. I kind of wonder about that because of this sort of legislative fix that's going to be demanded. There's going to need to be more cooperation in Congress than they're used to doing these days. So this tax, just to be clear, applies to covered employees, and that is defined as your high fives, so your top five highest paid employees in the current taxable year or any preceding taxable year. So if you have lots of, I mean, not many of you are in this situation, but if you would have lots of highly paid employees that go over $1 million, or you know, that get parachute payments, you could actually have more than 5 in a given year, because once you're a top 5, you're sort of always a top 5. We're talking about a tax on remuneration, and that basically just means wages. There is a sort of loophole. I mean, there's an attempt to close a big loophole here by making remuneration count from all related organizations. So if you're part of a system, like a health system, you can't sort of game this tax by getting compensation paid from multiple entities to the same person. There is an exception for compensation that's paid to doctors and veterinarians, and you may have heard about the so-called physician exception. It's sort of a physician exception, but you have to be careful because it's actually the compensation that is paid for their medical services. Some of you will have physician employees who perform other kinds of services that are not medical, and to the extent that that's what the compensation is for, it would be subject to this new tax. Excess parachute payment means that upon separation from the organization, they're getting a severance, and the severance exceeds 3 times their average base comp over the last 5 years. So that is the definition of excess under this new law or new tax. The last point on there should say that it applies to all top 5 highly compensated employees. So you don't have to make more than $1 million for this to apply. It's calculated separately from the sort of excess comp that I just talked about, but it's still talking about your top 5. It's the same covered employees. If you don't have any employees that are paid more than $120,000, this is not going to be an issue for you. I will say that you got to keep your eye on the ball here in terms of the general rule that as a tax-exempt organization, if you're a C3 or a C4, there are excess benefit transaction rules that have not been changed. So all compensation to your organizational insiders, your disqualified persons, which is basically your executives, has to be reasonable, no more than reasonable. There's not some new regime where it's fair game all the way up to $1 million and then you get this separate excise tax. The new excise tax is applied to the organization, not to the recipient of the excess. The old stuff, the excess benefit transaction rules, directly affect the person who receives the excess benefit, and they'll be taxed individually on that excess. So if you're not kind of going through, this is sort of a different topic, but if you're not today determining the compensation for your executives by using what we call the rebuttable presumption procedure, that's something that you should think about adopting, and I'd be happy to talk to you about that. The last thing that I wanted to mention is this very, very, very specific tax. I think of it sort of as the middle finger tax to certain private colleges and universities that have large endowments. This boils down to about 30 total institutions in the United States, none of which are in Minnesota. But it is a tax that essentially applies to the income on large university endowments, private university endowments, not public. It applies to any college or university that has at least 500 students and at least $500,000 in basically endowment assets per student. This tuition paying part was added actually after the initial act passed and was largely seen as a nod to Leader McConnell because it had the effect of exempting a college in his district from this tax. So there's a college in his district that basically ensures that every student gets a full ride through, you know, an aggregation of financial aid, and so they don't pay tuition. So we have that part, so we don't, there's sort of one less university to which this applies. And that is a quick flyover of sort of the new taxes, and Wade's going to talk about other stuff.
That's right. I'm going to talk about a few things that actually were not part of the 2017 Tax Act, but which still affect nonprofits. The first one, which you might be aware of because it came out kind of late in 2017, so the IRS released a request for comments about donor-advised funds. And kind of background, the tax code effectively prohibits a donor to a donor-advised fund from requesting that the sponsoring organization that holds the fund make a distribution to that donor that provides more than an incidental benefit to the donor or somebody else who has these advisory privileges. And the IRS has received lots of questions about that over the years since Congress first adopted this definition of a donor-advised fund in 2006, and we've been anxiously awaiting regulations ever since. This is kind of a first step towards that. So the first issue that this IRS notice deals with relates to charity events, you know, like an annual gala or something like that. And the question that the IRS has been fielding is essentially if, you know, I want to go to an event at a charity, their annual gala costs $500, let's say, and $50 of that goes to cover the meal, and $450 is really a gift to the charity. Can I pay the $50 for the meal and then recommend that my donor advised fund pay the $450 that is a gift to the charity? And the IRS says that its current view on that is the donor advised fund really can't do that. It provides more than an incidental benefit to the donor and would trigger that kind of prohibitive tax. A lot of charities and individuals have spoken up and said, hey, we don't like that idea. And that's really different than if I, as an individual, paid the full $500. The charity sent me the proper kind of receipt. I could take a deduction for the $450 that exceeds the value of the dinner I got in return. And so charities have said, you know, it's really not different to involve the donor advised fund, and that same rule should apply here. That's a decent argument and might be what the IRS ends up doing. Kind of interestingly, in some public appearances by IRS officials, they pushed back on that a little bit and said, well, sometimes the person who establishes the donor advised fund isn't the person who gets to make these recommendations. It might be the original donor's kids or different family member. And so in a situation like that, it seems more clear that the person who's attending this dinner is getting some benefit from the donor advised fund paying the part that's really a gift to a charity. So this isn't a final rule or anything, but the IRS just kind of announced its thinking on it and might change its thinking in response to comments. The second issue that the IRS is considering relates to charitable pledges. So if I go out and make a pledge to a charity and then later ask my donor advised fund to make a payment to that charity, it's kind of in satisfaction of the pledge, and people have asked, you know, does that provide more than an incidental benefit to me? Is that prohibited by the rules? And this time the IRS has a lot more friendly rule, which says that, it's okay for the donor advised fund to do that so long as the sponsoring organization holding the fund doesn't reference the existence of the pledge when they make the payment. So it's people kind of criticize this as it's kind of a don't ask, don't tell like rule that might actually be kind of hard to administer, in that what if the sponsoring organization knows about the pledge, and when the organization that I made the pledge to gets the money, are they going to know that I intend this to satisfy my pledge, or are they going to ask the sponsoring organization? And so it could create some complications, but it's still an improvement, and it's a helpful rule for charities that the IRS has said that you can rely on right now until the IRS releases further guidance about it. I think the reason that, or part of the reason that this has been such a question, is that in the context of private foundations, the IRS and the tax code are pretty clear that a private foundation can't satisfy a legal obligation of, a disqualified person of the private foundation, the director, the person who set up the foundation. So then the issue turns on, well, is this pledge legally binding? And the IRS points out that that is not an easy issue to answer. It depends on state law that actually varies quite a bit from state to state. And so charities have said, and the IRS says, we hear you, that we don't really want this issue to turn on whether or not the pledge is legally binding, because that is often complicated and not really clear. For example, when people ask us about if pledges are legally binding in Minnesota, we have to rely on two really old and kind of vague cases from, the turn of the last century. So it's not as easy to resolve as it might be. So the IRS is looking for a better way to solve this for donor advised funds. Yes. Sure.
So my question is from the point of view of the nonprofit. So you're booking pledges. You're going, traditionally a nonprofit would write off the pledge, accept a brand new gift from the donor advised fund. Now what I'm hearing is we cannot, we'll take it as a payment on the pledge. Will that get the nonprofit in hot water with the auditors?
That's a great question. So the question is, if the nonprofit that receives the pledge decides to treat that as the distribution from the donor advised fund as satisfaction of the pledge, is that going to raise problems for the nonprofit? Can they do that? I think it'd be really helpful if the IRS rule spelled that out more clearly, because it's a great question. Are we providing some kind of benefit to the donor? I think the intent is that the IRS is saying that's okay, and it's not going to be a problem, but it's not 100% clear. The IRS proposal does say that it has to be the charity that receives the distribution that decides whether to treat it as satisfaction of the pledge. So if the charity wanted to be really hard-nosed about it, they could say, yeah, this is from a donor advised fund, it's not from you, and so the donor, you're still on the hook. Charity probably isn't going to do that if they want to keep the donor in good graces, but so the IRS is kind of trying to push this issue onto the charity that gets the funds, but they haven't totally answered the question about whether that's okay, although it kind of suggests that they think that it is. Let's see, where was I? Oh, yeah, we are rapidly approaching the end here. The third issue that the IRS talks about relates to the public support test, which many of you know, but is complicated. The distinction between public charities and private foundations. And in order to count as a public charity under some classifications, you have to receive broad support from the general public. And there are special rules that say if you get a contribution from a single individual, either doesn't count as public support or it only counts as public support to a limited degree. Because otherwise, if you get a large contribution from one individual, then you start to look like a private foundation. And the IRS is concerned that people are using donor advised funds to kind of get around these rules about the public support test. So the IRS is proposing to kind of disregard the donor advised fund and say that, if I make a gift to a donor-advised fund and then recommend that the donor-advised fund give that money to a charity, the IRS is just going to view it as a gift directly from me to the charity, kind of cutting out the donor-advised fund in order to preserve this public support test idea that if I had made a gift directly to the charity and it was a really large gift, it might not count as entirely public support in this calculation. Charities have really pushed back on this idea. There have been a lot of negative comments, so the IRS might walk back this proposal because charities have pointed out this is going to be difficult for us to administer. We're going to have to figure out, is this money coming to us from the sponsoring organization? Is it coming from a donor-advised fund? We're going to have to do a lot more math and record keeping than we're used to. But I think the IRS has pointed out that it is definitely possible for people to use donor-advised funds to kind of get around these restrictions and make a gift that would turn a public charity into a private foundation if they had made it directly. So it's not 100% clear what the IRS will end up doing about this, but it's an interesting issue.
And that whole issue is made more problematic because of what Sheryl was talking about, where the stuff that applies to individuals is encouraging this behavior of bunching gifts and putting them into DAFs, and then now we're struggling with how to treat a gift out from a DAF. So those two things are in conflict or tension that makes it a little hard.
Absolutely. And I think with that, we can turn it over to questions. If anybody has any.
Right, and we've got some materials at the end that you can look at on your own about a couple of the other things. So yeah. Let's open it up to questions if anybody has any, and we're also here afterwards if people just want to stop by for individual questions. Sarah's a plant. Yes, Sarah.
This one doesn't start applying immediately, is that right? Wait, some of the other stuff in the notice, you can treat it as if it's a rule or otherwise. But if I'm remembering right, this one you don't have to start doing this until further notice.
That's exactly right. Sarah's asking or telling us rather this rule is, or it's not a rule. It's not even a proposed rule. The IRS is just saying we're thinking about this. Give us comments, but it doesn't change any rules that exist right now. Yes.
So one of the comments I just wanted to make is that we have some of our donors who are aware of this pledge conundrum, and so they won't actually pledge. They'll just give us a verbal intent, and then when the gift comes through from the DAF, it's a single-year commitment. And so I just wanted to, maybe the way to address that is to talk to the donors who typically have a donor-advised fund or a community foundation that they use to make those gifts. I do have a question about this charitable bailout in this business session. I didn't really understand the mechanics of that appreciated property. Could you just quickly review that again?
Yes. So it's the same general concept with lots of good bells and whistles as would apply to public securities, okay? If a donor starts a business, he's got virtually no basis in his stock in that business because he's the founder. And so that donor, let's say, is ready to, or getting ready to retire. And wants to pass it on to his kids. His kids may already own some of the business. He may have gifted shares in that business. I feel like I want a whiteboard, but let's say that he's already given each of his kids 10% of that business. He still owns 80. He's philanthropic and wants to make a charitable gift, but wants to do it with his appreciated stock. So rather than gifting that stock to his kids, okay, let's say he's going to do it slowly over time. So he's going to do 10% this year. Slowly over time. Rather than giving 10% to his kids this year, okay, if he gives that stock to his kids, he might have gift tax implications. His kids take on his capital gain in that stock. Instead, he could donate that 10% to charity, take a charitable deduction for fair market value, not recognize that gain, and his kids or the company turn around and buy that stock from the charity. And so he's gotten a tax deduction, he's got no capital gain, and his kids, by virtue of buying that 10%, let's say that there's 2 kids, they each had 10%, and now they each have an additional 5% from the 10% that he donated, and they bought. And it's just a way of avoiding the gain, getting a tax deduction, and avoiding gift tax as well. Now, in the gift tax environment, everybody's got an exemption at the federal level of 11,180. So that kind of structure may be more applicable to somebody who's in a taxable situation, but what if that is the asset that the donor just wants to give? I mean, that's what he has, is his business. And so he's not concerned about taxes, but he's concerned about philanthropy. That would be an asset that he could give. And even if he's not concerned about estate and gift taxes, he's avoiding the capital gains tax on that asset, which is still a benefit under the new tax law.
And that transaction would have to be completed in how much time?
You want more time than less time. There's an idea of the prearranged sale that says that if the IRS or if the donor, if there's, this gets long and involved. The IRS will collapse the transaction and cause the donor to recognize gain if there is a prearranged sale. The definition of a prearranged sale is that there is an absolute obligation by the charity to sell, so you can't have any options out there. There's also at least one court case that says if the sale is a practical certainty, then it is also a prearranged sale. So you want more time between the gift of the stock and the redemption or sale to the kids. Yeah?
Could you just comment on the difference between a DAP and how the United Way handles charitable grants?
I'm not sure how the United Way handles.
Well, that's...
I work at the United Way.
There you go.
You can comment.
Okay. I guess a simple way, do any of these tax law changes affect how the United Way operates?
They do affect the way the United Way deals and relates with donors. The standard deduction being raised affects us in that we are concerned about some of the smaller level donors not obtaining tax benefits. So, but we are not a donor advised fund. We make the decisions about who our grantees are. We have 100 agency partners that we select. But nonetheless, there are donors who give substantial gifts to the United Way and use donor choice or donor designations, and we are, in some sense, a pass-through. But we aren't at the moment subject to these donor advice. We're not segregating accounts for under somebody's name and making grants under that person's name. So
even if they designate that
the donor gives us $10,000 and says, I want $5,000 to go to my alma mater, we don't like that, but we do that. But that is a clear, complete pass-through.
Well, I think it's important to note that that donor-advised fund definition can be a fuzzy animal. I mean, it's the requirements under the law are that it be a fund that is identified with respect to the donor, so that's one qualification, where the donor or his named people expect to have advisory privileges. And so, you know, that segregation idea I think is important. Sarah, you may have more on this, but I think that, you know, that notion of I'm a donor, I make a gift, it's still my pot that I'm going to tell you what to do with. Granted, you have the legal right to not listen to me, but all of those characteristics, and I think people can run into trouble with, you know, depending on how they're defining their funds and how they're taking in gifts, and do you somehow inadvertently fall into being a donor-advised fund, or does the fund fall into that? We've dealt with that with IRA rollovers, because remember, those can't go to donor-advised funds. And, you know, where you have a fund that walks and talks like a donor-advised fund, you know, maybe you haven't called it that, but that's not the definition. The definition is, how does it work? So, yeah.
Okay, I've got another nonprofit question. So, the DAP rules and the consideration around special events, I've heard three different interpretations of this from financial advisors to their clients, and then I'm sitting there as the nonprofit. I mean, what is the onus on the nonprofit? That's number one, especially as the IRS is trying to figure this out. Because we will have donors that come with, like I said, three different interpretations. The third one that we didn't cover today was, my advisor said I can make a gift, sponsor a table at an event, and fill it with people I choose one I don't attend.
Interesting. I think that it really isn't the charity's obligation to sort this out, which is nice. And it's kind of an issue of, you know, has the donor received more than an incidental benefit from this gift, and the tax is on the donor, and I think on the management of the sponsoring organization as well. So the charity that's receiving the grant, it's not directly, you know, your problem, which is nice. As far as sponsoring a table, I don't know how the IRS would view that. If the donor's receiving a benefit of the dinner in return, then, you know, that would fall within their rule. But if the donor's not there, it's maybe a little more gray. I'm not sure. And
the disqualified person rules relate to that as well.
Yeah,
so the donor's spouse and the donor.
Right, it is.
Yeah.
You're right. It is the donor's family members as well, and the excess benefit rules that apply to all public charities also apply to donor-advised funds in addition to this incidental benefit rule. So it's a tricky area.
Right. And I know we're over time, so people should feel free to go, but you should feel free to stay and ask questions too. Up to you.
Well, thanks for coming.